we are going to year 4. There is a concern. We have to read the case. There's a concern in year 4. What does it say? It says the relevant, follow that word, the relevant fixed cost will increase by 8% annually in each of the subsequent years before declining by 6% annually, annually, effective year 4. From year 4, we are going to drop. It would mean in year 4, I'm going to have 840 times by 6% times 0.94. And therefore, the answer you get was going to be equals that figure multiplied by 0.94. And even in year 5, it continues to drop. In year 5, I will have 789 also multiplied by 0.94. 100 minus 100% minus 6%, you get 94%, and that's why I'm multiplying by 0.94. But now we were told these were before inflation. These were before inflation, and therefore, remember my figures have been rounded off for the sake. So inflation, we go back and read. When is inflation starting? We go and read. We go back and read. Inflation was hidden somewhere. Inflation was hidden. Inflation was starting year 2. Therefore, we go and look at the real cash flow. The list, it means we are on year 1. Year 1, the relevant is 720. Because inflation starts in year 2. So we'll have 778 times inflation 1.08. And when I do that, I will have that figure I multiplied by 1.08. That's what I should be able to get. Allow me to round them off to the nearest whole number for the sake. In the exam, you will make your own decision. This is going to be 840. You multiply it by 1.08. But it is running for the second time. You raise to the power of 2. And therefore, that's what I'm going to do. 840. You multiply it by 1.08 raised to the power of 2. I should be able to get 980. And in year 3, year 4, I'm going to have 789. I will multiply it by 1.08. I will raise it to the power of 3. And when I do that, I will have that 789 times 1.08 to the power of 3. Yes. And when I do that, I get close to 994. Remember, I rounded off my figures. So here it will be 742, 742. You multiply by something to learn here is that inflation. The way I'm dealing with it to the power of 4, because the cash flow was not uniform. So it will be that figure multiplied by 1.08 to the power of 4. And therefore that should be, this should be what I'm looking for. That is the cash flow I'm looking for as your fixed costs. That one will go into your table. Will go into your table, and that's what we've been looking for. So take note. This is the inflation adjusted cash flow we were looking for, but there's a lot to learn from this. There's a lot to learn from that. Then we go Continue reading. Remember, we are doing very many things, including inflation, growth, and inflation. The next, in addition, the diversification will necessitate additional investment in working capital equivalent to 40% of the company's existing working capital of 7.2, and thereafter increase by 15% in each of the years until it is recouped. But remember, there is inflation. Remember, there is inflation. Therefore, we go and do working capital. Another, this was too much. Those who did the mock, this was too much. Yeah, that's what you will find in the exam. Working number 5. We're looking at working capital. Working capital. So the working capital, we shall have the year, shall have the required, I think there's inflation adjustment. Let me do it following the same format here. There's inflation adjustment. And then at the end of the day, we shall get the movement or the increase. This movement should have inflation in it. So let us start and see. We shall survive in Excel here. So in year 0, the required, the question is very clear. The required, we can go and look at it. Okay, where is working capital? You will need working capital equivalent 40% of the company's existing 7.2. So right now, in year 0, we are going to have 7.2 multiplied by 40%. When you do that, you could start in year 1, it doesn't matter, but you could also start from year 0, 7,200 multiplied by 40%. I think I'm a little bit slow, but it is okay. That's what we have. Then we've got year 1. We shall need to look at year 1. Before we bring in inflation, then we go and read. Before we bring in inflation, the relevant working capital, we are still in the required. The working capital, the final relevant, which is the movement, is the one that will be adjusted. But now the relevant working capital will increase by 15% in each of the years until its recovery in the final year. So when I come here, I'm gonna bring 2880 multiplied by 1.15. And when I do that, I should be able, that is the 288 is the required, which is relevant, times 1.15. And the process continues. The process continues. At this stage, I'm sure you know what we're doing. We shall have year 2 here. Year 2, I'm going to increase the 3312 multiplied by 1.15. And then year 3 is going to be 3809. I will grow it by 1.15. And in year 4, I will have in year 4. In year 4, I will have. In year 4, what will I have? I will have 4380 times. It said will continue growing by 15. We get that. However, because we started in year 0, in year 5, you simply write the word recoup. That's why he said until recovery, if I had started in year 1, I would the 50, 37 would appear there. So take note of that. And now we bring inflation adjustment. Inflation starts in year 2. That means this figure will not be adjusted for inflation. In year 2, in year 0, you should take note that actually the figure for year 0 here, the 28, is technically for year 1. And therefore the figure for year 2, will remain because inflation starts in year 2. What we see, the 2880 is technically the figure for year 1. And therefore the figure 331. Let me use this column here. Soon we shall get it. This is still required, but I want to bring in inflation, and the answer will put it there. Because I'm in next, this is still required. So the required here is still 2880. And therefore, because that is the required, it will be the figure we need. You will not adjust, you will not affect it for inflation, which is 2880. Inflation starts in year 2. Therefore, this figure of 3312 remains as 12. But here, there is no figure there. So when I come to year 2, I'm going to have the 380 adjust it for inflation. When I adjust it for inflation, let me first bring the figures here. 2880. This one is remaining 3312. Therefore, when I adjust that for inflation, I'm going to have the 3809. You multiply by 1.08. When you do that, you should be able to get 4. Allow me to round off. That means in the following year, it will be 43. Remember, I'm trying to survive within Excel while you pick a leaf. But this one is repeating itself for the second time. And therefore, I will come here and get this figure times 1.08 to the power of 2 and that's what we should be able to get. This 104 year, that will be repeating itself the third time. So 37 times 1.08. Inflation now shouldn't be a problem based on what we've been doing up. And here we should be able to get equals this figure. You multiply it by 1.08 to the power of 3. And when you do that, you get 6,345. Remember, remember in my case, I rounded off early. Therefore, that shouldn't worry you. Now, the very first one in year 0 is the movement. That's what you want to take to your NPV table. But always, now when you look at these two figures, the one you have adjusted for inflation, of course I brought them here, there was no inflation there. This figure and that, it is increasing. That means you are injecting. I'm going to get that figure minus the figure below it. I will be able to get an injection. And these two are also increasing, meaning there's another injection. And these two further increase, meaning that there is another injection. And when we look at these two, the way we got that, because it was the difference between the two, and finally in the final year, how did we get? We have to continue. This one is increasing to that. Therefore, we have to get another figure there. But beyond this, there's nothing. It means you recoup, as indicated earlier this way, that actually you recoup. And normally you recoup the figure you see there. Normally you recoup a figure you see there. That's the figure you recoup. The recouping figure is 6,345, such that these are negatives, but when you add, overall you get 0. So this working, the working on working capital was really a challenging one. We pray that eventually in your exam that is there next week, you don't get those complications, etc. The problem is that inflation adjustment, a good area for learning. So we're left with one working. We're left with one working. We should be done by 4. So the proposed capital expenditure will qualify for capital allowances on reducing balances, and the tax is 30% payable in which they arise but has negotiated, and the tax will be in arrears. So we go and apply, I think that's the last one. We go and apply what we know. We go and apply what we know. So working number, this is working 6. Working 6, we are looking for tax allowable depreciation, commonly abbreviated TAD, but also known as capital allowances. Whereas we are sending this, there are very many ways of dealing with this. Stick to what you know. But at MAT Abacus, we usually lay out our data. We usually have the details. We usually have the details. That's how we do it at MAT Abacus. But there are very many ways of doing it. Details, then we usually have the TAD. It is important you quote the rate. The TAD, it is reducing at 25%. So at 25%. And then, sorry, TAD at 25%. And from there, we usually have TAD at 25%. That's how we do it at MAT Abacus. Then we usually have the net book value. Some people call it the written down value. And then we shall have the tax relief. The tax relief. And in this case, the tax relief. The tax relief, we shall go by the tax. We shall go by the tax rate, which is 30%. And we end up with the timing. That's how we do it at MAT Abacus. Timing. So I will position my my table so well. So that is it. So we have got year 0. Normally in year 0, usually begin with the cost. The cost of this machine was 9.5. Remember, we are doing it in millions. And therefore, in year 1, we shall have year 1, year 2, year 3, year 4. The machine is for 5 years. Let us read again. Is it 5 years? Let us see how they are depreciating it. Depreciating for 4 years. For only 4 years. Even you can see it from 25%. It is 4 years, not 5. The project is 5 years, but this one you are depreciating it. So, in year 1, what we do, we shall get 95,000. We multiply it by 25%. And when you do that, that is your TAD. It's going to be that figure times 25%. And here you'll be able to get the balance. Balance should be that. And the process continues in that direction until year 3. Into year 3, year 2, the way we do it at MAT Abacus, you will get 71.25. Multiply it by 25%. You will be able to get the 17, and the balance will be that. And in year 3, we shall get the 5344. Multiply it by 25%. When you multiply it by 25, you get that. But in year 4, we either look for balancing. For us at MAT Abacus, the answer is the same. We don't depreciate in the final year. We bring here our scrap. We bring our scrap. This figure here, the scrap was known. Earlier, the scrap, the scrap was known. We had the working for scrap. Scrap was 1,900. So we bring our scrap of let us go back. In which year is the scrap? Let us check the question. The scrap instead, the proposed investment will yield economic benefits for a period of 5 years, after which it will be scrapped at 20% of the initial value. At that level, we might not scrap it. We might not scrap it. At that point, we might not scrap it because we have depreciated for only 4 years. This is the challenge with this number. Therefore, we should continue depreciating. There is a 5th year, but we are only doing depreciation for 4 years according to the question. That is the challenge with the question. You don't go live the way you are used to do your things that actually. So in this case, we should have depreciated because this asset is for, the project is for 5 years. When we are scrapping, but we're only depreciating, we are only depreciating for 4 years according to the question. In year 0, there is always no tax relief available. And the tax relief is always the TAD. You multiply it by the tax rate, which in this case is 30%. And when you run it, you will stop there. Therefore, if I round off, I should be able to have that. Because the tax we're going to pay in arrear, this will be in year 2, this will be in year 3, and this will be in year 4, and that will be in year 5. That's how you should have done your capital allowances. One lesson we learn from this is we are not depreciating the asset until the final year, because we were told we depreciate it for only 4 years, even though the project is for 5 years. So now we should be moving towards the conclusion. So we have taken a note of that. So where is capital allowance? So we think capital allowance, we have sorted it out here. And now we are done with that. You can proceed and populate your NPV table to get your best case NPV. But now we are left with the financing effects. We are left with the financing effects, which actually we need to sort out. We are left with the financing effects, which we need to sort out. However, this issue of scrap coming in year 5, and I'm depreciating the asset for for 5 years. I could have brought it in, because if I'm doing the depreciation up to that level, what happens to year 5 when I will scrap? I'm going to scrap, even though I've already, the asset is assumed by year 4 to be at 0, but it still has a figure. And therefore, because it has a figure, there must be a balancing charge finally. And it would be good if I brought the scrap here. It would be good if I brought the scrap here. Let us see. That one is a scrap. That is a scrap. If I brought in scrap there, it means if I compare the scrap, finally, even if the asset is not going to be depreciated, but there is some figure there, there's some figure there, it would mean that actually, since the scrap is less than the value of that asset after year 4, that means we're going to have a balancing allowance, because we are making a loss. The asset, we stopped depreciating it in year 4, according to the equation. It has a figure. Therefore, when I compare these two, we shall need to claim, because you scrapped. So you'll be able to get that figure minus that one. And therefore, in year 5, there's some, you'll need to claim, even though you stopped scrapping earlier. And that will go into year 6. I'd made that oversight. This will go into year 6. So I want to conclude. In conclusion, this is where we have now. Give me a break of 1 minute. Break of 1 minute. Just give me a break of 1 minute. I take some water. Now, ladies and gentlemen, remember we are dealing with APV. We said APV is best case NPV. We add there present value of financing effects. The best case NPV the cash flows will be discounted using KEU. That's why we had it one gear, the cosmetics industry. And whereas the financing effects will be discounted using the risk-free rate. Now, earlier when we were starting, I knew we would get tired, but when we were starting, we did say the financing effects are basically three. There is always tax relief on debt. Then also there is always, you need to look for the net savings benefit as a result, i.e. as a result of using a cheap loan, a subsidized loan, using a subsidized loan. And then finally, you also look at, the order doesn't matter, you also look at issue costs. Now, this question had all those three ingredients. So we shall go to the question. They are here. They are available starting from here. The proposed investment, the proposed diversification will be financed by both debt and equity in DHL's capital existing structure. The word is existing capital structure. Now, when we go to where we have started from, the existing capital structure of DHL was 35% debt, equity 65%. So we need to take note of that. And possibly, right, we are looking at financing effects. And existing capital structure, they are telling us the existing capital structure, they are telling us debt. They are telling us debt is actually 35%, and then equity is 65%. So now we go, here I'm not going to use Excel. We go and look at the equation. So now we are trying to trace those financing structure. If you missed a point in class, wherever you are, pick it from here. So now they are picking some debt from TEFE, and then UDB. So TBL is willing to finance 1.7 billion at 10%. So we can write here, TBL Bank, TBL is giving us debt of 1,700 million at 20%. But at the same time, we are going to get some money from UDBL. This is cheap debt of, I'm trying to interpret, if you look at cheap debt of what? They said here, the question says, you'll pick money from TEFE and UDBL. 1.7 is for 4 years. That is also key, 4 years. But their issue cost of 5%, let us note that. Maybe I will come to issue cost later. But there is the word, while the balance of debt finance will be financed by 5 years. So here, this is 4 years. Those are tricks, 4 years here. And here balance. Remember, we want to finance capital expenditure is equivalent to 9.5 billion. That means that balance is the same as saying if this is 35%, it's the same as subtracting. Or you could say it's going to be 9.5, because if we are using debt to finance and our capital structure, is a mistake here. Let us first wait. There's a mistake here. UDBL. No, I'm not right here. There's something small here. First wait. There's something very fun. TEFE is giving us 1.7 at 20%. However, total debt is going to be, according to they said we should be financed by according to their capital structure. Total debt is going to be 35% of 95 million. Meaning the debt you are looking for, if you get 35% of that, you will be getting 325 million. That means UDBL will finance the balance. Will finance balance of what? 325 minus what TEFE gave you. TEFE gave us 1700. The paper calls for writing these things down, and therefore what you will get from UDBL when you subtract that, 3225 minus 175, you should be able to get 1625 million. There is a problem also. This is for 5 years. This is for 5 years and at 8%. I will come to the issue costs later, but I wanted we note that. Therefore, there's 5 years. These are the problems you should be able to identify in the exam. So when we go back to our notes here, capture the marks. We did say when you're dealing with financing effects, you should trace the tax relief on debt. That's what I want to deal with. Then I come to net savings benefit. Me, I prefer to conclude with the issue costs, or you can start with the issue costs. Now, the tax relief on debt. So, one, we are looking for tax relief on debt. Note, if straight line meaning that the interest you pay remains the same. There is a year when he brought an equation and the interest was on reducing balance. That means you had to draw that table. But if tax relief, if you are going here, he didn't, the question doesn't tell you whether it is a straight line or reducing. Since you do a manual paper, you would go straight line. So in that case, tax relief on debt, if straight line, it is simply DTR. In other, you get the interest. This is the interest. This is the coupon interest. In other, to get the interest, subject it to tax. So to me, on TBL, the tax relief on TBL, I'm aware the loan of TBL is actually 17. The interest expense is 20%, and the tax relief is going to be 30%. And when I work out that, I use DTR. When I work out that, I will be able to get a tax relief of 102 million. And this is per annum. But you have to get the present value. You have to get present value. So the present value for that is going to be the 102 million times the discounting factor. We were told tax is payable in arrears. Therefore, you should be able to get the tax relief will also be received in arrears. So the one of year one will be got in year two. And because the loan was 4 years, you will continue getting up to year 5 because I'm trying to discount. Therefore, when you do that, you're going to have 102 million. That discounting factor, it means if you go to your table, we are using the risk-free rate of 10%, and that is an annuity. That is an annuity. So I have to look for the ordinary annuity. We want to look for the discounting factor from 2 years to 5 years. This table is cumulative. The 10% is here. If I do 5 years, the figure for 5 years is this. But I want it from year 2. Therefore, what I do, I will get 3.791. It will be 3.791. You subtract the one of year 1 because this is cumulative, 0.09. And when you do that, let me put it on the calculator. When you do that, you will be able to get 3.791 minus 0.909, and you'll end up with 2.882. That's what I'm going to take here. I will multiply by 2.882. And when you multiply that, the present value of tax relief here, tax relief, remember we are still dealing with DBL. Therefore, when you multiply that, you are going to get 294 million. But there was also a subsidized loan. You also do it. Tax relief on UDBL loan. Still use DTBL. That tax relief, the tax relief is going to be DTR. This is applicable if straight line. If it is not straight line, then you will be compute interest first, then proceed to get the tax relief at 30%. Our UDB loan was 1,625 million. The coupon rate, 8%, coupon rate is R, times the tax rate, which is 30%. When you multiply the tax relief you get, will be 39 million. This will be for per annum for 5 years. For 5 years. Therefore, the present value of UDB tax relief is going to be what? It's going to be that the tax relief, the 39 million, times the discounting factor. The discounting factor, the taxes are payable in arrears. Therefore, it will be from year 2 to year 6 because the UDB loan is for 5 years. And that means, comma, at 10%. We use the risk-free rate. So when we go to our table, 10%, you will need to identify the figure for the 4.355. You subtract off 0.909, and when you do that, you should be able to get a present value of 3.446. It's what you will use to discount that cash flow. So I'm going to have 39 million. I multiply it by the discounting factor, which we have already together, as 3.446. And when you do that, you will be able to get 134.4 million. Remember, it is increasing. That is all about the tax relief on debt. There were 2 loans here, each with a different coupon rate. That's why we have gone this far. However, we say the present value of financing effects will include tax relief on debt, which we have sorted out. Now we are going to go on the net savings benefit. How do we get the net savings benefit? The net savings benefit is done on a subsidized loan. We go and present that. We should be closing. Come and write here. You carefully write. It could be savings benefits. Savings benefit on cheap loan. It is always done on a cheap loan. I will show you how the net comes in. You ask yourself, what interest TBL is at 20%. UDB is at 8%. This would mean the savings benefit on cheap loan is going to be 20% minus 8%, and you will end up with 12%. Therefore, if you write savings benefit, it means it's gonna be the loan you got from the UDB, and the loan from UDB was 1625. I'm making a benefit of 12%. When I do that, let me do it on a calculator. 1625 times 12%. I'm making a benefit of 195 million as a result of borrowing cheaply. But ladies and gentlemen, I also suffer from a tax relief. So you write tax relief lost. The tax relief lost is going to be the benefit you got. You lost 30% as a result of that benefit. And therefore, tax relief lost, I will get 195 times 0.3. I will get 58.5. This is a negative, and hence when I combine the two, it's when I get the net savings benefit on the cheap loan. The net savings benefit. And when I do that, 195 minus 195 minus 58, you will get 136.5. That is the benefit I will be. That is the benefit I will be getting, not 195. But you should be able to know this is UDB loan. Therefore, the present value of net savings is going to be the 136.5 million. You discount it. You have to discount it. The discounting factor, UDB was 5 years to 6 years at the risk-free rate of 10%. And when you do that, you should be able to get 136.5 million, 10% 2 to 6 years. That annuity factor would go to as 3.446. And when you multiply, you will be able to get 474 million. Ladies and gentlemen, we are done with what? We are done with the net savings benefit. We are left with the issue costs. We were told that actually when you borrow from DBL, the 1.7 at 20%, there will always be an issue cost. So you're going to deal with the two issue costs. There is that borrowing from UDBL, mean DBL, and then UDB. You go slow. Please note, what you see is actually net borrowing. What you see is actually net borrowing. The rule is you borrow enough money, including issue costs. Therefore, we are looking at issue costs. These issue costs, i.e., DBL, we borrowed 17 million. This is net. That's what we got. And the issue cost was given as 5%. The rule is, unless stated that that was gross, always borrow enough, including issue costs. Therefore, we need to gross up. We need to gross up DTBL. And how do we gross up? We usually get the amount you got, the net amount, you divide it by 100% minus the issue cost. Therefore, we got 1700 million divided by 95%. When you do that, the gross amount you should have gotten, should have been 1789.5 million. Therefore, the issue cost of 5% is on gross amount, 1789.5 times 5%. Don't make that mistake in the exam. And the issue cost, when you gross up and get 5%, the issue cost is going to be 5% of that. You are going to get 89.5 million. Or someone could have said the issue cost could have been the gross amount, 1789.5 minus what you got. You'll end up with the same figure, 89.5 million. Now, ideally, the issue costs are in year 0. Therefore, the present value of issue costs will be 89.5 times the discounting factor. In year 0, you will end up with 89.5 million. However, there's a problem. We go to the question. If we continue reading, the equity finance will be raised through a rights issue of 2 shares for every 5 held at the date of issue, with associated 5% issue costs, which are tax deductible. Whereas the question is trying to bring the tax deductible issue on the equity raised, but one could have also taken it to mean that actually all issue costs here were tax deductible. If I don't include that, I would stop there. But if they are saying issue costs are tax deductible, it means that we are going to get a tax relief on that issue cost. Therefore, just for the follow-up, I can put here NB. The question states that issue costs are tax deductible. It means you get a tax relief on issue costs. Therefore, in that case, therefore, I'm still on that first loan. I will be able to get the tax relief on issue cost for the first loan is going to be, the tax relief is going to be the 89.5 times the 30%. And when I do that, I will be able to get 26.85 million. When I do that, I should be able to get the present value. The present value of tax relief on issue costs. We are in D, meaning TBL loan, and therefore that present value will be 26 point. This relief will be gotten in year 1 because the tax relief, the tax is paid in arrears. Therefore, we'll have 26.85 times 10% in year 1. I will get 0.826. And when I multiply that, I will be able to get 22.2 million. Now you go to UDB loan. You go to issue cost on UDB loan. If we go to the question, the UDB loan, we managed to get it as 1625 million. What is the issue cost there? The issue cost at UDB loan UDB loan is, while the balance of that, debt finance of that, subsidized from that at an 8%. UDB loan, we don't have issue costs. Therefore, there is nothing there. Then we go to equity. Equity finance has an issue cost. UDB loan doesn't have issue cost. Therefore, on equity finance, we were told the equity finance will be raised through a rights issue of 2 shares for 3 shares held at the end of that. But we already know how much we are raising from equity finance, because we know equity finance is basically, equity finance was known as 60%, 65, i.e. no issue cost on UDB loan as per the question. Then we want to look at now issue costs on equity finance. Issue cost on equity finance. Now, the net equity finance, net equity finance, we had done it. It is supposed to be 65%. 65% of what you need. That figure should be 6175 million. That is net unless advised. Gross equity should be, you remember the net 6175, you divide by 100% minus 5% because issue cost is 5%, and therefore the gross equity should be able to give you 6,500 million. Hence the issue cost should be 5% of 6,500 million. And when you do that, you'll be able to get 3 to 5 million. But we have been told, but issue costs are tax deductible. That's what the question says. A very good question for capping. Therefore, if they are tax deductible, we get the tax relief. I'm concluding the tax relief now is gonna be, the tax relief now is going to be the 35, the 3 to 5 million times 30%. And when you do that, you should be able to get 97.5 million. But taxes are payable in arrears. But I can put it for you, but tax payable according to the new policy in arrears. Because taxes are paid in arrears, then the PV of tax relief, the PV of tax relief, of the tax relief on issue cost here is gonna be, you get that, you discount that, it's going to be 136. Not 136. It is 97.5 million. We multiply by the discounting factor, which we got earlier as 8.26. Wait a minute. In which year is this issue cost coming? Let us see. Wait a minute. I think that is it. Interest costs. All interest costs are paid at the end of each year. Yeah, the one principal is paid at the end of the period. I think that is it. And therefore, you should be able to discount that and get, when you discount that, when you multiply that, you should be able to get 80.5 million. And therefore, once you go and you will conclude, you should be able to say our APV, adjusted present value. I'm concluding adjusted present value, APV, is going to be, then you assemble your results. You should be able to tell us the best case, which we didn't conclude, best case, NPV. You will bring that figure, and then you will bring tax relief. Tax relief on TBL loan. Remember that is present value. You'll also get present value tax relief. Tax relief on UDB loan. You'll bring it there. Then from there, remember you had the net savings. Net savings benefit, which you will be able to populate. Then you can bring your issue costs. tax relief, present value. There was a tax relief on issue cost, tax relief, not because these were in year 0, tax relief on issue cost, the loan DTBL, but also now we also had the present value slight mistake here, let me rub off here. Here you bring the tax relief on TBL loan because it was in year 0. Then that's when you bring the present value, no, tax relief on issue cost. On issue cost. Then you bring the present value with the tax relief on issue cost, specifically TBL. Please note, issue cost is a negative figure, but the tax relief will be a positive figure. Then there is equity finance, issue costs on equity finance, which will also be negative. Then you'll also get a present value of issue costs on equity. This will be a positive figure. At the end of the day, when you gross up all these, you'll be able to get your APV. You should be able to get your APV. How do you comment? If your APV is positive, the project is financially viable, in line with the way I advised on how you should always make your conclusion. Ladies and gentlemen, we have come to this review. We have taken long because I was in between Excel, etc. There are very many lessons to learn from this. I pray you go and conclude and populate our NPV table such that you are able to get your NPV and you live a better life. It is already a few minutes coming at 5 p.m. and therefore stay well. May God bless you. Thank you.